Search for the best mutual funds online right now. You will find hundreds of articles. Every single list is different. Every fund claims to be the definitive choice, leaving you with 30 random fund names and zero clarity on what to actually do with your 5,000 rupees a month. These lists fail you because they rank funds on one metric, historical returns. They completely ignore the reality of your individual situation. A fund boasting a 24% trailing return over 3 years sounds incredible on paper, but buying into that kind of aggressive growth guarantees you are exposing your money to extreme, unpredictable market volatility. This line chart compares the expectation of that 24% return against actual market reality. If the market takes a sudden 40% drop and you happen to need that money for a house down payment right at that moment, you are forced to withdraw at the very bottom. You lose your capital, regardless of what the 3-year headline return promised. The right large-cap fund earning 13% for your specific goal beats the wrong mid-cap fund earning 22%. The ideal choice is entirely dictated by your withdrawal timeline and your emotional tolerance for market crashes. Instead of giving you another list, we are going to build a personalized decision tree. First, ask yourself exactly when you need to spend this money. Under 5 years, short horizon. 5 to 10 years, medium horizon. Over 10 years, long horizon. This decision tree maps out the options. After plotting your timeline, you answer question 2. If your portfolio dropped 30% next year, would you stop your SIP out of fear? If the answer is yes, you are a low-risk investor. If you would hold steady or increase your investment, you are moderate to high risk. Combining these two answers cuts through the noise. It drops you into one of 3 specific investor scenarios. Answering these questions honestly helps you build a strategy that accounts for your own reaction to market swings. It provides a logical framework designed to help you stay invested when things get difficult. Scenario A is for investors with a 5 to 7 year horizon, who know they will lose sleep over a market correction. Your move is to put the entire 5,000 rupees into a single fund, the Parag Parikh Flexi Cap fund. A Flexi Cap fund gives the portfolio manager the freedom to invest across large, stable companies and mid-sized businesses without being strictly locked into a single market segment. What makes this specific fund suited for a conservative profile is that it allocates a portion of your money to global tech stocks like Alphabet. International exposure to companies like Meta acts as a built-in hedge. When domestic Indian markets take a hit, these global holdings often hold their ground and stabilize the overall portfolio. Historically, this setup has delivered a steady 15% return over a 5-year period, alongside a highly competitive expense ratio of just 0.6%. You are trading maximum potential upside for the emotional stability required to actually stay invested when the broader markets turn red. Scenario B is for investors with a 7 to 10 year timeline. You understand that markets correct occasionally, but you still want a reliable safety anchor to prevent major drops. This comparison matrix highlights the balanced setup. You split the 5,000 rupees. 3,000 stays anchored in the stable Parag Parikh Flexi Cap, and 2,000 goes into the Nippon India Growth Midcap Fund. The Midcap Fund accesses India's high-growth, mid-sized companies. These businesses are agile enough to outpace major corporate heavyweights during bull markets. Over the last 5 years, that specific mid-cap fund has returned 21.6% annually. By blending it with your stable anchor, your historical portfolio return rises to roughly 17 to 18%. To capture this growth, you must hold the portfolio for the full 7 to 10 years. That is the time the mid-cap portion needs to recover from inevitable market corrections. This setup balances downside protection with the potential for compounding growth over the medium term. Scenario C is for long-term investors with 10-plus year horizons. You do not panic during massive market crashes. You simply view them as opportunities to buy at a discount. You split the 5,000 evenly, 2,500 into the HDFC Flexi Cap Fund and 2,500 into the Motilal Oswal Large and Midcap Fund. As this matrix shifts to the growth row, you can see the results of this equity-heavy approach. Over the past 3 to 5 years, these funds have historically generated between 18 and 24% returns. The trade-off here is extreme volatility. This portfolio will swing hard. Surviving these periods requires the discipline to ignore your portfolio balance for years at a time. Value Research analyzed 25 years of historical data on the Indian stock market. They found that for equity SIPs held 7 years or longer, negative return outcomes were rare, even if you started investing at the absolute peak of a market bubble. This scenario maximizes long-term wealth, but only if you have the discipline to look past cyclical market panic. The most destructive mistake you can make is logging into your account and pausing your SIP contributions just because financial news turns negative. Look at this market drop. Keeping your SIP running means your 5,000 rupees buys more units at a cheaper price. This is rupee cost averaging. When the market recovers, those discounted units increase in value, making your total corpus grow significantly during the recovery. The math shows that temporary market crashes are actually a mathematical advantage for long-term investors. Your unwavering discipline during a panic cycle dictates your ultimate wealth far more than picking the perfect mutual fund ever will. If you start a 5,000 rupee monthly SIP today and stay invested for 10 years, you will contribute a total of 6 lakh rupees. This bar chart maps out the math. At a conservative 12% return, your 6 lakh turns into roughly 11.6 lakh. At 15%, it reaches 13.9 lakh. And under an 18% projection, you cross 17 lakh rupees. Your money doubles or triples primarily because you stayed in the market consistently over a decade. Please note, this framework is for educational purposes and is not SEBI-registered financial advice. You should always consult with a qualified financial advisor before committing to any long-term investment strategy. If you are ready to apply your scenario, you can use the Groww link in the description below. Search for these funds and automate your SIP in under 5 minutes. Forget the top 10 lists. Understand your timeline, acknowledge your risk tolerance, and let time do the heavy lifting for your wealth.